Good afternoon. I'm Christine Serlin, editor of Multifamily Executive. Welcome to today's Multifamily Market Update with my colleague, Kimberly Byrum, who is managing principal here at Zonda. Before we get started, I want to run through some of the latest news happening at Zonda. First, we have some upcoming events, and I want you to save the date for our MFE conference, which will be September 26th through 28th in our new location of Dallas. Also, if you're an affordable housing owner or developer, make sure you mark your calendar for November 13th through 15th for our annual AHF Live conference, which will be in Chicago. Also coming soon in July is our new rental housing outlook. It'll be curated research subscription of Zonda's advisories, best ideas for less than the cost of an entry-level analyst for the build to rent and single family rental market. We also just launched Livable, North America's most comprehensive and accurate listing platform for new construction homes. Our free to list site is dedicated for builders to showcase their new homes and communities. Please check out livable.com today. Also from Livable, we have our innovative 2024 concept home, which will be coming out soon. You can go to 2024concepthome.com where you can sign up for the wait list to be among the first to see the home and receive a 10% off coupon to purchase the house plans. At Zonda, we also feature market snapshots where you can find essential housing insights for the top 65 metropolitan and micro statistical areas across the country. So now I'm going to turn it over to my colleague, Kimberly, who is going to share some of the latest from the multifamily industry with you today. Thank you.
Thank you, Christine, and happy to have everyone on the call this afternoon or morning, depending on where you are. Just wanted to remind everybody before we get started that we are here to help. We are based in Dallas, but we work all over the country. We have experts strategically placed in the Mountain West, in Austin. We work on about 25 studies a month, really no off-the-shelf reporting, all customized research for our clients, and we'd love to help out with any questions that you have in today's environment. I think it's even more important to have your research in line. So jumping right in, want to talk a little bit, obviously, about the markets, which we do each time we have this webinar, and want to drill down a little bit in as it relates to the tech markets and what we're seeing there and how that might be moving into some of our more diversified economic markets. So we'll talk about that. Really talk and dive into what is high supply, what is the pipeline. We're hearing a lot of headlines about that, and some actionable items for what we can do about those things. And then finally, I just wanted to share some case studies, or what I'm calling bonus content, on just some of the different challenges that we're facing as we're underwriting things like office conversions, and then switching gears and talking a little bit about townhomes. And just some of the design specs and things that we're seeing emerge out of this product type. So I always like to start with just some of the talking points in the headlines. And if there was anything that I would say right now, we are definitely in a holding pattern. And a lot of what I'm hearing from people is that deals just don't pencil. And so what does that mean? Well, first of all, obviously cap rates are up, but it's really hard to predict where they are right now because of the lack of transactions. Going in yield expectations are up in the 6 to 7% range is what I'm hearing. Obviously, underwriting rent growth is down from where we have been. We're estimating, or what we're hearing is between 2 and 3%. And obviously, I love to read through the REIT reports and get their guidance on that. Pro forma rents, which is what we spend a lot of our time on, are down, and they're really hard right now to defend in this environment because a lot of the research that we have done and the underwriting that we did was occurring during a lot of those rent surges. And so where are we at today on our pro forma rents? Construction costs are flat. We have not seen any evident signs of decreasing costs yet. And from what I'm reading and all of the different indices that we analyze, we're seeing that much of these costs right now are driven by the labor in the market. And so we're hoping that there will be some relief on that as the pipelines start to clear out. And then finally, and this is maybe a little wishful thinking on some people's part, but there are planned projects that are definitely being postponed or re-underwritten and maybe abandoned, with the idea that some may come back to market during a pre-purchase development opportunity. So overall, that's yet to be seen. Certainly haven't seen that wholesale in the market, but something that we're watching for. And obviously, and I like this quote from the Avalon Bay transcript of the first quarter call, where they point out that during times like this is where we've made some of our best bets and made really great investment opportunities during this time. So just want to remind people of that. I definitely don't want to share just Debbie Downer. Shifting to the right, this is one of my favorite charts to take a look at on an ongoing basis, and this is the Conference Board's expectations from consumers as it relates to their job and where they feel that the economy is going and where the labor conditions are. And just overall, the blue line represents how people feel today. And so as you can see, we still have a pretty good attitude about, what my present situation is. And just if you take a look at this over time, obviously during the great financial crisis, we knew that there could be times that were better, but that blue line during good times always seems to be higher than where your expectations are for the future. So definitely seeing that orange line go down and tick down, kind of in some of those Great Recession territories, where people's expectations are for the future, that they're a little bit worried there. So that is kind of the context in terms of what our renters are thinking. And certainly overall, taking that into account as we're making some long-term decisions and interacting with our customers. So jumping right into just the chart that I'd like to start with, where are we at in terms of occupancy and fundamentally rent growth? So if you go back to the pandemic times, the first quarter of 2022 was our all-time high of occupancy, I think in my career, certainly. So 2022 was a banner year overall for just the industry and certainly from an operations standpoint. So we have come down and actually ticked a little bit shy of 95%, so bumping in the higher 94% range. And that was expected, but we're definitely operating more in that long-term historical perspective. When you look at the rent surge, that again, we talked a lot about, that began in 2021, that second quarter there. We have peaked out in that third quarter of 2022 and come down slightly. And so when I hear big headlines about rents coming down, I always tell people I really need to see this chart beginning in December of 2019 to really understand, when I hear the term the rents are coming down, because certainly they have stabilized and come down very little and have flattened out. And so we are heading into our prime leasing season. This is data as of the first quarter. We're a couple of days into May at this point. So, we haven't seen a lot of the cards turned over yet in terms of where we're headed in the summer. And so all of the things I'm reading, everything I'm hearing as I talk to clients, is that things seem to be going, all systems kind of go back to that normalcy. So we will continue to monitor that. So reversion to the long-term trend question mark is what I have here, because this slide 6 to 8 months ago, I was definitely predicting that we would get back down into that 50% renewal range. But all of a sudden, mortgage rates have increased. And so that 20% of our residents that we typically have lost to home ownership over the long-term trends are staying put a little bit more. So rather than getting back right down to that 50% historical range, we are seeing kind of that 52, 53. And again, I think that math lines up really well with those people that are just staying put right now and not making home buying decisions. Looking again at UDRs, data, they said only 5% of their move outs in the first quarter were due to home purchase, and that is a 60% less than their historical average. So again, going back to that consumer slide, we're seeing people just, they feel pretty good about where they are right now. Maybe they are going to go on their European vacation, but they're not going to make a big move that will cost them more long term. So overall, we think we'll see that stay a little elevated compared to the history. Stabilized concessions, I say this all the time, they are definitely a good indicator of where the market is. And you can see that we've ticked up a little bit, but I don't think you really got to use your microscope to see what that tick up looks like. And so I would say we're kind of hovering around the bottom. As we look at comps and we update rental rates and we talk to clients, when we're seeing some of those areas where the pipeline is starting to increase and those lease up concessions are getting back to 1 month free, we have seen maybe one or two of the stabilized competitors jump on the bandwagon to some degree, but not anything wholesale. So it's not really impacting the overall numbers as of yet, but we will continue to watch that. And you can see that concessions are a pretty quick lever. They will start to show up in that data pretty quickly if wholesale people start jumping on the bandwagon and offering those concessions. So overall, still pretty, I would say, at the bottom of where we would expect in terms of stabilized concessions. So there was a lot of headlines at the end of last year about traffic coming down. And again, really considering this trend and carving out second quarter of 2021 through second quarter of 2022 is kind of that COVID, really hard to unexplainable trends that happened during COVID. You can see that fourth quarter of this year, we definitely came down like we normally do. And I think that's, again, one of the things that we're hearing from a lot of the management groups throughout the country is that we're seeing this, return to that seasonal pattern. So first quarter, we ticked back up from fourth quarter. We're not as high in some of the markets, and I'll show you by market here in a few minutes, as we have been historically, but definitely that trend to back up in the first quarter. So heading into the second quarter, I've just created this, quote, forecast to say, hey, benchmarking wise, we should expect our traffic. If you just look at the normalized history over time, we should expect second quarter traffic to improve by 10 to 12%. So as a benchmark, if you are not seeing that in your portfolio or at properties, and certainly at properties in tech markets, that maybe it's time to start thinking about some of the other ways that we, keep our occupancy high and keep our residents, our renewals high. So that's a good benchmark that I'm looking for to kind of start the conversation about what are the actions that we should be taking. Jumping into some of the development markets. So this is more of a reminder than anything, but just the markets with heavy tech presence. And I'm defining that using the Bureau of Labor Statistics location quotient. So the location quotient of 1.0 means that you have an industry, and in this case, the tech industry, that is equal to the typical US economy. So over 1% means that, or 1.0 means that you have more tech occupations in your market than the typical national average. So no surprise that San Jose is at the top of that list. I also pulled in median annual wages for just the overall sector. And these numbers are actually as of May 2022, so they have not been grown. The numbers have not been released for 2023. But so overall, there's a couple things here I wanted to point out. Obviously, we don't always think of Washington, D.C. as a tech market, but they do have a heavy, mostly on the security government side, obviously, but there is a tech presence there. Austin, probably one of the interesting things to me when I look at this group of tech markets is how that wages in Austin are somewhat lower than a lot of these other markets. It's a little surprising that we have seen some pullback in Austin in terms of employment because it is one of the more affordable wage markets for tech workers. On the other side, I thought it was just interesting to say, hey, what are some of the smaller markets that also have large tech presences? And so you've got Boulder, Colorado, Huntsville, Alabama. I think they've got the big space program there. Madison, Wisconsin, if you're a Badger. And then also Trenton, New Jersey. And again, to point out that many of these markets, Austin is competitive with in terms of the wage growth. So just an FYI, but to keep that in the back of your mind. So I get my head spins when I see lots of bars and charts. So I'm going to share a couple of scattergrams with you. They're just so much harder to explain. So bear with me. But so what I'm trying to illustrate here is two things. So on the vertical axis, we have a job growth. So that's the percent of jobs increase year over year as of March. Okay. And so you can see if you use that vertical line, that national average is somewhere between, it's 2.7, so just a little below 3%. So on the on the horizontal axis, what I'm doing here, and I like to look at momentum. So I will take job growth just month over month over month and look at how it's changing, because you will see, where the momentum is increasing or where the momentum is decreasing. And obviously, since the Fed began their interest rate increases in August of last year, we have started to see the markets and the job growth momentum slow down, which was an intentional move on their part. So overall, my line in the sand there is a little over 30% change in momentum. And you can see many of the markets are kind of falling plus or minus 30 to 40% change. And then you have a few outliers over to the left. Riverside and Denver are really the two that have dropped the most in terms of job change over this time period and are at a very low job growth percentage currently as of March. But there are also mostly, and these are the popular markets that we underwrite most of our projects in, are still falling above 3% growth year over year, and this again as of March, and are also lower, haven't lost as much momentum, if you will, as some of the other markets. Obviously, the markets that are over 30 but still above 3, a lot of those are those tech markets that I was showing you in the previous slide, places like Austin, San Francisco, Raleigh, but interestingly, not San Jose and Seattle. So you've got a little bit on the edge right there. But overall, all of these markets are still above that 3% year over year job change, which is really positive. Obviously, Vegas benefiting a lot from just the COVID bounce back of travel across the world. And then, of course, the pandemic boom towns such as Jacksonville and Tampa also above those market areas. Places like Dallas, places like Nashville, Charlotte, those were growing pre-pandemic and just continue to see the momentum there that we've seen overall. Phoenix, which sometimes gets a bad rap, right on the line, right in that same growth momentum. DC is always a little on the slow side, but overall you can see a lot of our markets are still performing well in terms of those job creations that we really look for in the apartment industry. So kind of shifting gears a little bit, I was talking about traffic earlier, and so I wanted to show you how the traffic has changed in the first quarter. And so a couple of things here. The markets that have a green line are reporting first quarter traffic exceeding history. So while we came down and I showed you that first quarter was back down, they are still outperforming what they had historically. So, and that's many of the markets, again, that kind of fall in that positive momentum, high job growth area for sure. Those in the purple are primarily markets that are tech driven. Denver, of course, being a really large outlier, although Austin's, above pre-pandemic. And then those with boxes around them, not only are they outperforming pre-pandemic levels, but they're doing it by double digits. And so again, Jacksonville, Boomtown, LA, Anaheim, and then Houston. And I always kind of chuckle about Houston because Houston overall really marches to a different beat in terms of the markets because of their heavy oil presence and the cycles that they have are a little bit different and a little sometimes lagging the way the rest of the markets are. Interestingly, and of course, traffic in the first quarter is driven a lot by weather. And so I looked up the historical weather patterns, and lo and behold, because the Southeast was performing so well, believe it or not, Atlanta, Charlotte, and Tampa actually reported the warmest first 3 months of the year in 129 years. So definitely seeing people out and about and obviously looking for apartments. So renewals. And so I've broken up this data into two classes of metros. We have our tech heavy markets, and then we have just our very attractive typical markets that we all operate in. So I want to focus first on the tech markets, and this is actually really interesting. And there was an article in the Wall Street Journal today about home prices declining for the first time and I can't remember how many years, and they cited a lot of those tech heavy markets. But interestingly, we're seeing renewals actually outperform in most markets the last 12 months. So the last 3 months were even stronger in most of the tech markets than they were in the last 12. So the dark purple is the history, and that's 2010 to 2019. So a long history of renewals. The mint green is the last 12 months, and then the lighter purple is the last 3 months. So you can see here that other than Denver, Austin is a little bit on the edge of underperforming its long-term historical average. But overall, Denver is really the only one there that kind of catches my attention in terms of maybe, and again, we're already seeing signs of that in job growth and other things. The traffic it's all kind of lining up there consistently. The other markets to the right-hand side, which are the more traditional multis without as much, much diverse economies, of course, Houston, not so much. You can see they're actually off peak a little bit. So certainly that mint area, that mint green was an all-time high for many of these. And when you look at that occupancy coming down, you definitely see that illustrated in the data here that the renewals have come down somewhat. Again, Houston, the outlier there, it's just kind of lagging and coming along and looking a little bit more like a tech market at this time, but seeing really high renewals there. Phoenix, again, you heard a lot about that, but they've come down off of their last 12, but still certainly very strong. Phoenix has a pretty low renewal rate historically compared to other markets because it was historically a big home buying market. So that's changed a lot as they built more housing, but overall definitely outperforming their history. Another point I wanted to make on this slide, as we're updating rents and looking at comp by comp, one of the things that I'm noticing certainly in more of the traditional markets is some of the revenue management systems are starting to push 15-month lease terms with more favorable pricing. And as you look into revenue management systems, not only are they trying to maximize rents and minimize turnover, they're trying to stagger their leases so that they have less at risk at certain times of the year. And so we're seeing some 15-month lease terms being the most lucrative pricing for a potential resident that would sign a lease here in the next 30 to 60 days. So how is absorption doing? And I took two different markets. And again, I'm kind of drilling down into some of these tech heavy markets to see, where are the chinks in the armor and, where should we be paying attention? And so the chart on the left is the lease up submarkets in Denver. And so I'm looking project by project and trying to understand how they're absorbing during their first 18 months or 12 months of lease up. And so 2022 is the dark purple, and then the mint green is 2023 year to date. So arguably through April primarily, maybe a little early May. So, taking that slower leasing time for sure. But you can definitely see that we're off absorption trends from last year in most of these markets. And again, there's a different basket of comps doing things differently. It's just how many properties were in lease up and what was their average absorption pace. So you can see here absorption in Denver at this point, even though you see a lot of those momentum numbers are pretty severe, absorption's down about 25%. And the number of units in lease up has increased by 15%. So they're absorbing more, they're absorbing at a slower pace, but they have picked up more properties in lease up. Overall, we are seeing about a month free in these markets, which is consistent with last year. So again, not seeing that get over its skis, so to speak, with Denver, in getting in that 2 or 3 month range. So we're definitely seeing on average about a month free there. If you turn to Austin on the right, Austin has definitely seen a much faster slowdown has the same number of units, so really haven't received a barrage of newer, more units in the market. And so definitely, early into the year, we are seeing the absorption trends down almost 50%, 45%. And concessions have doubled, but they've doubled to a month free. So we were really probably absorbing a year ago in Cedar Park 30 units a month with no lease up concessions. Now we're absorbing, little less than half of that with a month free. So overall, pretty consistent across the different submarkets. If you look at this slowdown, it's been pretty wholesale across the popular submarkets. So one more scatter chart that takes a while to explain, but again, I really like where this is going, because, talking about future pipeline, and we hear a lot of the headlines and we hear a lot of the big numbers. And so what I wanted to do was frame it up in a way of looking at it in terms of the size of the market as well as the pipeline. And so just generally, one of the ways that we like to measure how big the pipeline is we take the number of units under construction and we divide it by the existing stock in a market. And as a general rule, that line in the sand that we all kind of look at is 3%. So 3% of existing stock or less means, okay, we're getting pipeline, but we're not getting overrun by pipeline. So that if you look at that horizontal axis, 3% is my midpoint there, or my equilibrium point, if you will, in terms of just the number of units being built. So on the other end, or on the vertical axis, what I wanted to do there was I wanted to look at just the number of units in a market, and I wanted to compare that to the renter households in a market. So this is a very static measurement, but just to kind of get a sense of, here's the existing inventory, and here's how many people, that we have to chase around, or how many households we have to chase around in the market in order to fill up our units to the whole way. And so 1.5 is kind of that line in the sand that I've drawn in terms of, okay, if we have 1.5 renter households for every unit that's in the market, then that's we can close on 50% of the traffic that walks in our door. So that's probably a really good place to be. So obviously, when you look in these quadrants, the best quadrant is that top left quadrant, which is the low pipeline, low existing inventory market. And so in that area, no surprise, the California markets, kind of live there. But then you also have San Antonio, for instance, that has, building less than 3% of their total inventory and still has about 1.6 renter households for every unit that's on the ground currently. Obviously, the Tampa's the COVID boom town, and that one lines up really well, as does Las Vegas, where we just haven't really ramped up the building there like we have in some other markets. So not seeing that, and certainly not overbuilding our existing inventory. Then you go into that lower left area, and I have that in gold, and the reason for that is this is our low pipeline, so we're not building a lot, but we do have high inventory. And I want to asterisk this with, a lot of these are the older markets and some of the largest multifamily markets out there. Dallas has a lot of units, as does Houston. And so I would say that, I would take, for instance, Dallas with a little bit of just a question mark there, because there is obsolescence that I'm not accounting for in that existing unit inventory. So I'm not really worried about those markets. They are older, again, not building very much. And I would say, if you made some adjustments, Dallas would be kind of up closer to 1.4 or 1.5, and Houston would probably be right at 1.5. So overall, I think those are still great markets in terms of pipeline to renter households. Over on the right-hand side of your screen, you've got the high pipeline, low existing inventory markets, which again, there's some competition there, but still not building as much as we need. And places like Orlando, Phoenix, Jacksonville, Charlotte, all those places kind of come into play. And then that at the bottom is probably where we might be a little worried. And this would be places like Denver, Raleigh in the short term, that's just got a real big building boom coming online. And then Austin, of course, again, we've already pointed out that there's some momentum loss there. So where does the pipeline, where are we going? And we've heard a lot about no starts right now, there's a lot going on in that category. I really wanted to put some numbers around what we're looking at. And again, this is the top markets that we operate in. So what this is everything that's under construction, and I have examined it and I have analyzed it using a percent of completion methodology that we use here at Zonda when we're forecasting pipeline. And so this is everything that's being built. It's going to happen. And when is it going to happen? And taking into account slowdowns and all the things that have occurred over the last few years, the slippage. So overall, as we're operating right now, we are about 4.6% up from what delivered last year, which, okay, I would say that's about normal, right? And I think one of the biggest, brightest spots that people haven't picked up on, but the REITs are actually talking about it in their reporting, is that if you're opening a project today, you are probably 10% higher than your original pro forma. So you look really smart right now because you were able to ride that wave up, and we really haven't seen those rents come back down yet. And you probably had 1 month free in your pro forma. So you really look great. You're really sitting in a great spot right now in terms of as you begin your pre-leasing this year. Next year, we're definitely going to have more pipeline, and that is kind of the peak year in many of these markets, where we're going to see about 20%. I think that our pipeline that's on par is going to increase by 20%. So we're going to see that. We're going to see some more concessions entering the market. Hopefully that's enough that the growth can sustain and we won't see this concession seep into the stabilized market, but that's where we will be watching. But then it falls off completely. And this is where a lot of people are looking right now, and they're calling this the future tailwind. And that is 2025, in which we know that everything that's under construction is going to decline by 25%. I'm sorry, 5% in 2025 or 6%. And then it will continue to decline after that another 12%. So we're looking at 2025 and 2026 as years of decrease in number of units that will be built just year over year. So where are the markets slowing down the most? And of course, it's usually where they're building the most. But overall, Sacramento and LA, where of course, if you go back to the quadrant that I previously presented, they need more units. So that's unfortunate that they're contributing to the slowdown. Fort Worth, also somewhat of a pullback. Then Denver and Raleigh, and I have asterisks by there just to remind you that those are those heavy tech markets. And then just kind of rounding out the bottom would be Houston, Phoenix, Atlanta, Charlotte. So overall, and everybody is slowing down, but these are the ones that have really the largest double-digit contribution to those slowdowns in the future. So just real quickly, back to basics. I wanted to just share, and I know that many of you guys already know that, but just kind of talking through, what are some of the actionable items to consider when you are operating in these high pipeline markets. And I'm a simple kind of bucket person, so I always start with traffic. And gave you that metric earlier, that 10 to 15%. I mean, where are you sitting compared to first quarter? Closing ratios. I found, and I pulled this out, I thought this was absolutely interesting, especially in terms of all the AI that we're talking about. But Tom Toomey said in the transcripts for the first quarter that their bots have a 10% higher closing ratio than their call centers. So I thought that was really fascinating. And if you've never talked to one of those bots, it's actually, when you're doing research, you can get pretty good information from them. Also just looking at office hours, looking at closing ratios, training, but really just starting with where's the traffic? Is the traffic down? What are we doing here to maximize our traffic? And then secondly, considering going into the product. And this is something, how easy is it to do business with you? If I have to pick up the phone and call your leasing office to get a rent for a unit that I've looked at online, the chances are I'm not doing it, or I'm calling and I'm not getting anybody on the phone. And so going through and just checking through that, how easy is it for me to educate myself on what it's going to cost if I want to move into this unit that I found online that I think meets my needs? Are you in a commoditized market? And I always there's nothing wrong with a commoditized market. Any sub-market that's maybe 1,000 or more units under construction and in leasing, that's a commoditized market in many ways. And so how do you stand out in a commoditized market? Well, it's amenities. It's the amenities war, right? Well, so are they usable? if I go online and I read your resident reviews, does everyone complain about how the fitness center never works, that there are no weights in it or whatever? So knowing that we're competing on an amenities basis, we want to market them. I want to see pictures of them, and I want to know that they're working and in their good shape, because if I'm going to pay you this amount of money, I'm paying for those types of amenities. And then finally, pricing is the last place to go, but of course always the first solution in everybody's mind. But don't let the revenue management system run itself. That needs to be highly monitored, effectively monitored. Develop staff compensation programs that are in line with your revenue expectations, and over communicate your revenue expectations. A lot of times we focus on expenses, which are also very important, but the top line, I always say revenue saves a lot of things. And then just finally, just communicating weekly is something that, we constantly do when we get in on this repositioning or working with different marketing aspects. I mean, just remember, going back to that slide that we talked about earlier, our residents right now are rather apprehensive about future prospects in the business and labor markets. And so they don't really want to make a move. So don't give them a reason to. So switching gears, and we have a few minutes left, but I wanted to share a couple of the special research projects that are top of mind in our team and with some of our clients. And wanted to start with office conversions. There's so much press on that right now. If you Google, you'll read the New York Times, Texas Monthly. Everybody's talking about how we're going to convert all of these old office buildings to residential units. And so we actually have quite a bit of experience, believe it or not, in Dallas, in DC and other places, Philadelphia, and I always used to joke and say, when the market gets to the office conversions, then we're really at the peak, but that's not the case anymore. And so I just wanted to share some things. But first of all, one of my absolute favorite things to do is to read resident reviews. And obviously they're always really angry, and some of them are really funny. But they are a wealth of information. So I went and mined just some of the words that people are sharing as it relates to actually living in buildings that have some mixture of either office, residential, and or hotel. And I think what really resonates the most with me is just this natural conflict between people that are living in a building and people that are doing business in a building. And it's just something that's reiterated over and over again. And that is just prioritize. How do you show your residents that you are prioritizing their needs over the businesses that are in your building? And so things like, I feel like a visitor in my own building. The employees either don't care or just aren't empowered to prioritize our experience over the retail and commercial leases. So those are just really important ways to balance, the different uses in a building. We always talk about how great it is, but there are a lot of things that have to be overcome. I think another thing that to just call out here, and you can read all of these yourself, but is the pet policies. We hear all the time that everybody has a pet, and it's a really, really, I don't want to walk my clients through a building where someone's in their pajamas standing outside, letting their dog relieve themselves. So you can see that here. It says, I literally had a member of the building security chase me across the grass with my dog yelling at me. So we've just got to come up with some solutions as we're designing these buildings to address some of these really, really just easy issues to address, but important issues. As we underwrite, one of the things that we do, and we're constantly surveying residents, this is actually the results of a survey that was conducted in Houston, of all places. And what we were asking respondents is, what is your preferred community design? And this is urban dwellers. And so number one, and this was a select all that apply. I like all of these different types of housing situations. And so obviously in an urban setting, they prefer a high-rise apartment building between 6 to 15 stories, as well as a multi-level townhome, believe it or not, or a low 4 to 5 story wrap. And those are kind of the three different preferred product types. But you do see that about 8% of the people that responded to this survey said that they would consider a complex design that was a renovation or a retrofit of an office building or a warehouse. And also just defining that it may not have walking or parking within, but you might have to walk from your parking to your building. So overall, total addressable market in an urban setting might be somewhere around 10% of the people that would be interested in that. So, as you're doing your depth of demand and trying to understand, the number of units that might be demanded in an overall urban setting, you could say, up to 10% of the people might be interested in this type of housing. So how do we underwrite it, and how do we adjust for some of these obsolete, because I've heard, oh, it's always X or it's always Y, percent less than a new build. And that's just really not the case. What we like to do is analyze it building by building by building. And we apply the research of things that we know about what residents want in their buildings. And we try to understand, because there are some things that are actually positive about office buildings compared to maybe a newly constructed residential building. And so, things that we consider and adjust for are things like, what floor did the residential unit start on? Obviously, the higher the better. We'd like to have unobstructed views. Certainly, when you're inside a commercial area, you might have buildings on 3 or 4 sides, and so we'd like to be as high up in that building so that we can maximize that view. Obviously, ceiling height in the unit. That can be a detriment if it's too short. Obviously, we typically build 9.5, 10, so want to see that or even more. Balconies, if you can retrofit them, or if they're there in some types of buildings, that is a positive for sure. Certainly more in an urban setting, want to see that outside. The size of the windows, are there views? Are they obstructed views? Are they operable windows? Those are things that we want to underwrite for. Number of elevators, that is one of the positives about some of these high-rise buildings that are existing, is they may have more elevators than we typically would see in a new construction. Parking, how does that work? We want to understand that. People definitely like the charm of a historical building. And then again, what are the mixes of uses? Understanding that office and residential mix can really cause some problems. But overall, we want to underwrite to those things. So finally, and we have a few minutes left, and I joke about this, but the multifamily industry stopped building townhomes. And when I say townhomes, I mean overall 100% townhome projects in the 80s, because they were just really difficult to make work. And now they're emerging again in this build for rent space as we're, trying to maximize density on less dense sites. And so rather than just complaining about it, which is what I sometimes like to do, I wanted to do some research and understand, what can we learn from the product that's on the ground? And, how can we apply that and make better townhomes in the future? And so just wanted to share a couple of things that we're seeing. It's really hard to find 100% townhome deals. And so, mining through the data, I'm just considering anything in that 2-story range could potentially be a townhome. It could be a 2-story garden, or it could be a townhome. And so overall, kind of mining through the data, you can see that obviously some of the more dense metro areas not seeing a lot of townhome product, but places like Phoenix, where the build for rent landscape is the most vast, you're definitely seeing a higher percentage of 2-story units that are entering the market. Dallas also, if you overlaid just the popularity of build for rent with this little chart, I think you see many similarities there. But overall, it's starting to emerge again as a percentage of the pipeline. So again, what are some of the things that people like about townhomes, and what are some of the things, as we're contemplating design, that we need to take into consideration that are challenges? And probably first and foremost, one of the things that's really striking to me is that people that live in townhomes actually call it my townhome. They don't say my apartment or my unit, they will literally call out the fact that they live in a townhome. So there is somewhat of a pride of a townhome living, so to speak. And so if you're naming your community, make sure the word townhome is in it. Make sure that in all your marketing material, the word townhome is in it. People, it's just a step up, I guess, in their minds from saying apartment. And so I think that's a really positive aspect of it. But overall, a lot of the benefits are in the layout, right? They like the kitchen layouts. They like the natural light because of the pass-through units. They like the attached garages. Again, porches and yards, that's also part of that build for rent lifestyle that people are searching for. Storage. They love the fact that there's a lot more storage in a townhome. And then just overall, the word spacious interiors. On the challenges side, a lot of times the 3 stories, people don't like those as much as the 2 stories. And in fact, we've even analyzed deals where they have 2 stories and 3 stories, and you can definitely see that there is, a negative rent adjustment for the 3-story unit. So that's something to take into account. There's always in 100% townhome communities a lack of extra parking because they are more dense. And sometimes people complain that the garages are still too small for SUVs. So the size of the garage needs to be taken into account. Obviously, because 100% townhome communities are typically smaller, you have fewer community amenities, and typically they don't support, because of the unit counts, as much staff. So maybe the service level is not where it needs to be compared to a 300 or 400 unit apartment community. So design specs, and again, kind of building off the idea that this is, people love the space, people love the design. Those are some of the most important things. You know, what can we learn from what's on the ground currently? So there's a lot to digest here. I'm going to park here for a second so that you can take a look at this, take a picture of this, hand this to your architects. But I thought I took every floor plan that I could find in 100% townhome units, and I analyzed it in terms of the average size and whether they had, how big their living spaces were, if they were giving dimensions for that, if they had defined dining space, how big it was. And so a lot of different things going on here, but just generally, you know, one of the things that's really fascinating as you go from a 2-bedroom to a 3-bedroom townhome, you get a little bit more square footage in the living room. You actually lose dining space, but you get a bigger master in these 3 bedrooms, just generally speaking. In the 3-bedroom, you've got similar size 2nd and 3rd bedrooms, and the same amount of den, study, flex space, 5 fixtures, but you do swap into an actually defined laundry room when you get into that 3-bedroom. Shifting over into the 4-bedroom, fascinating that you actually lose living space generally. You pick up dining space, and your kitchen actually gets a little smaller, but you get much more den space. You get 5 fixture baths, and you get really big laundry. And in fact, I've seen some design in 3-story townhomes with laundry chutes from the 3rd story to get down to the 2nd story. So some really unique, you know, kind of overcoming that 3rd story issue. Another thing, in the 4-bedroom, you've got obviously a large master, but you also have a larger 2nd bedroom. And then there's that 3rd and that 4th bedroom get to be around the size of the 3 bedrooms and the 2-bedroom 2nd bedrooms. So overall, you see that, you know, really the space shifts, which I think is quite interesting in terms of the specs. So how do they perform? Well, I think we all know that generally townhomes are getting about, you know, 2 times a submarket rent, driven by those larger unit sizes. Obviously, there are lower rents per square foot. You know, there really was no good data to say, oh my gosh, townhomes outperform occupancy wise, because there are so few of them in the market. There's just a lot of volatility. And then the project sizes are just so much smaller. There was no clear cut evidence that townhomes outperform in terms of occupancy levels. I would say that in analyzing rent growth of townhomes, at least the ones that are in the market today, they are consistently performing with the submarket. So again, not necessarily outperforming. And I would say, just when we're underwriting anything, you know, that is in that larger unit size, we're constantly using that collar of income limits that really top out for the pricing of some of the size. So there's some real critical elements to consider when you're designing, obviously the size and the specs, but also just, you know, how big can we really get, and what will the market support in terms of pricing. And so finally, again, as I mentioned earlier, it's really hard to find 100% townhome communities, but I do have a couple of them that are either coming to market or we've been studying for a couple of years. And so again, take a quick snapshot of these, but again, these are hitting the market, and we'll continue to survey them and understand them and see how they're performing, and excited about that over time. So just a real quick wrap up. Want to thank you for joining us, and, you know, just drive home those points that we've dropped in occupancy. We're slightly better than average. We haven't seen big adjustments in rent growth yet. Renewals a little bit higher than the history. We think that people are skeptical. We think they're going to stay put for a while, so keep them happy. Stabilized concessions remaining low, constantly watching those to understand where the market's heading. It's such a great leading indicator for us. Leasing concessions are increasing. Again, back to that 1 month free for sure. Heavy pipeline markets, we're going to continue to watch those as we go into that peak leasing area. Hopefully we'll see some ramp up there. And then finally, just remember those actionable items and starting with traffic, moving to product, and then adjusting pricing.
Thank you so much, Kimberly, for the wonderful presentation. Everyone, stick around for a few minutes. We have an excellent survey that you can take if you'd like some follow-up information on what was presented today. And also keep an eye out on our social media channels for the recording of today's webinar. You can also check it out on zondahome.com/blog, and it will also be emailed to you within 24 hours. And if you scan this QR code here, you can sign up to subscribe to our email so you can learn about our upcoming events. Thank you so much again, Kimberly, and everybody have a wonderful day.